Well, a very warm welcome to our event today. My name is Guntram Wolf and I'm the director of Bruegel, and I'm pleased and honored to host today the president of the Eurogroup, Mario Centeno, who is the outgoing president. As we all know, Mario has been in that position for many years now, but there will be an election for a new president of the Eurogroup in only 10 days. And so we thought it's a perfect moment to reflect on the Eurogroup, of course, the past of the Eurogroup, but also looking forward at the future of the Eurogroup with its new president. So the future of the Eurogroup after the COVID-19 pandemic, or perhaps during the next phase of the pandemic, let's put it this way. I think there's really nobody better placed than Mr. Centeno to give us his insights. He's, of course, not only the president of the Eurogroup, but he's also professor of economics and has been minister for the Portuguese government, Minister of Finance. And so we are really very much looking forward to his remarks. Before I give you the floor, Mario, let me give a housekeeping announcement. So for our audience, online audience, please do join us live also on the app Slido, and type in the word Eurogroup, and then you can ask questions, and I will use some of those questions in the second part of our conversation and post them to Mr. Centeno. So please do join us Slido, and the password is Eurogroup. Without much further ado, Mr. President, very much look forward to your remarks and your initial remarks, and thank you so much for joining us today.
Good morning, you all, and thank you for the kind words, Guntram. It is a huge pleasure to come to Bruegel. I am indeed in the final days of my term as president of the Eurogroup. This was a more rewarding period than I could have imagined. Today, I would like to draw on my experience, but reflect on how the COVID-19 crisis will impact the process of EU integration. So a little bit looking into the future. Lack of trust has always been a drag on economic integration. The feeling of extreme and widespread vulnerability caused by the COVID-19 pandemic compelled Europe to take a leap of trust, coordinating dramatic and unprecedented policy actions. In no more than 10 days, the Eurogroup agreed on 3 key safety nets for workers, businesses, and sovereigns. The European Council is poised to mandate the Commission to borrow from markets to finance the recovery, in a scheme that entails fiscal solidarity among EU member states. I share the sense of opportunity of those who see this as a big step to fully explore the institutional framework of our economic and monetary union, and indeed a step towards a fiscal union. This is Europe in the making. At this time, it really is different. The single market, as we know, it is at stake. Hard Brexit is still in the cards. The US follows an unpredictable economic and foreign policy. Difficulties are elsewhere. Indeed, they are everywhere. And they do not belong only to some of us. Europe has no other place to look at or to rely on. There is no Marshall Plan, nor moral hazard-based reasoning to impose country-specific policies. This time, we need a truly European plan. A delicate quid pro quo will underlie the impending agreement on the recovery instrument. Member states with more fiscal leeway agree not to abuse from flexibility as they shield their economies. Others should commit to use the available financing wisely to future-proof their economies. Respecting the two sides of the bargain will be key. Otherwise, we will pit member states against each other, fueling the forces of disintegration. It is a gamble, We are taking it in the name of the 76% of Europeans that express their support for the single currency, and we have no excuse to fail. We may need a few years to fully evaluate and repair the legacy of the crisis. The crisis implications will play out across several dimensions. I'd like to focus on three: fiscal rules and economic coordination on one side, EU own resources second, and third, the financial integration dimension. Starting with the fiscal rules and the role of economic coordination. To enable country-specific responses to the crisis, we have activated the General Escape Clause within the rules of the Stability and Growth Pact. This was quite right. In face of an exogenous temporary shock, increasing public spending to keep people in jobs and companies afloat is a public insurance policy, the opposite of austerity indeed, the definition of an active fiscal stabilization policy. We were in uncharted territory with the lockdown measures, but we should now return to textbook-like policies. Soon, we will have to withdraw what is meant to be temporary. A gradual return to our fiscal rules will need to be properly engineered. We must remain cautious on how we use our rules. A leading example being potential output. At this stage, is it warranted to translate this impact of an exogenous temporary shock in the potential output of our economies? We must not forget that we are in the middle of the largest social experiment in modern history. Statistical models must deal appropriately with this temporary break. They cannot overrule the political narrative that allow democracies to keep people at home and leave their jobs unattended. The fiscal rules are not meant to signal that. What was meant to be temporary will now have a negative, permanent, and self-fulfilling effect on our lives. In a context of uncertainty and uneven recovery trajectories, a premature fiscal tightening would undermine past efforts. We must not return to a negative spiral of potential output fall, fueled by a lack of confidence and coordinated fiscal austerity. We also need to think about the appropriateness of the rules, as they are in fact important for the coordination of our policy stance. To what extent will our framework remain fit for purpose in the post-COVID-19 world? There are three defining issues to be settled in my view. The first concerns the debt rule. The pandemic adds to case for reflection over improvements to its application, as it will bring about or accelerate some deep structural changes in our economies. I am not just thinking about the large expected increases in public debt, but also about the uncertainty on the future levels of interest rates, inflation, and growth. The second issue concerns the quality of public expenditure. This will be critical, as fiscal sustainability will need to be made compatible with large investment needs. The fiscal rules fail to properly distinguish between growth-enhancing expenditures and other budgetary programs. Previous attempts to make the rules smarter have failed over concerns about free riding and moral hazard. The experience with the Recovery and Resilience Facility, the so-called RRF, may offer a practical way forward while avoiding the pitfalls of trying to head to what would never end up being a complete contract. The RRF will finance national programs of investment and structural reforms, devised and assessed against the recommendations identified at the European level. Members will be subject to a more intense level of coordination and analysis. This was exactly the idea behind the Budgetary Instrument for Competitiveness and Convergence, the BIC, European funds that are used according to commonly defined euro area priorities. The RRF process embedded in the European semester could provide a way to identify national expenditures that should be treated more favorably going forward. My third point is about improving fiscal and economic policy coordination in the euro area. The RRF funds will be raised and distributed to all European Union members. The funds allocated to the euro area member states should be used in a way consistent with the objectives of the monetary union to help us to avoid the buildup of imbalances. To ensure this, we should include a reference to the euro area recommendations in the Commission's proposal. The Eurogroup should discuss the priorities for investment and reforms in the euro area on a yearly basis. This falls short of a dedicated governance framework as envisaged for the BIC. Still, I am convinced a dedicated fiscal instrument will be needed for the euro area on a permanent basis. Let me now turn to the issue of own resources. The recovery instrument will be a temporary tool. The money will be disbursed over less than a handful of years, but the debt will be with us for more than 3 decades. The conventional way to finance repayments is to either increase future contributions from member states to the EU budget or cut future spending, which is nonsensical. The alternative approach would be to provide the European Union with new own resources linked to common EU policies. The Commission is poised to propose a menu of own resources before 2027. This has not been a simple debate in the past. A packaged approach with new own resources and a clear link between the proposed taxes and the strategic priorities of the Union could help to bring about a consensus. If new own resources are agreed, this could reverse the pernicious dependence on financial contributions to finance the EU budget. The third dimension is the integration of the financial system. The bad boys behind sovereign crisis, the banks, have emerged as a source of stability through the pandemic, extending a lifeline to struggling individuals and companies. However, the risk of contagion from the real economy to the financial system may increase as scars of the pandemic shock materialize. This will put the framework we have built to deal with troubled banks to the test, but it must not put us off from deepening the banking and capital markets union. This should start with the Eurogroup agreement to accelerate introduction of the backstop for bank resolution. There are some very concrete elements in our response to the pandemic that could facilitate further steps towards financial integration. To finance the emergency response and the recovery, the Commission is expected to issue some 150 to 200 billion euros annually over the next 4 years, making it an issuer twice as large as the traditional European supranational peers. EU bonds are not a substitute for a European safe asset, but they will give us a taste of it. Their impact on the workings of financial markets should not be underestimated. The recovery might also spur the rebalancing from bank financing and reduce our reliance on debt over equity. Financial integration would increase the resilience of euro area sovereigns to shocks and ease the pressure for stabilization through public resources. What is more, it could contribute decisively to strengthen the international rule of the euro. Let me conclude. Europe entered this crisis with the most advanced educational, health, and welfare state systems in the world. We had just experienced 26 consecutive quarters of growth, over 13 million jobs created, the most coordinated fiscal stance ever recorded in European Union countries, and an overall improvement in risk reduction. No other conditions were more prone to building trust. Yet, we stayed short of a big step. Today, it is tempting to see the new opportunity presented by our response to COVID-19. The bold measures we have taken so far give us reasons to be confident. But we must not take the outcome for granted. Allowing the European Union to borrow under its own name and redistribute funding to finance investments and reforms in the hardest hit members increases our responsibility. We must prove the added value of European Union action and work courageously to build on it. If the long-term implication of our response to the pandemic is not a more integrated Europe, we will have wasted a golden opportunity. Thank you all, and thank you, Guntram, again for the invitation.
Thank you. Thank you so much, Mario. This was a very, very comprehensive look at Eurogroup and what's going to be next, and many, many issues that can be discussed in more detail. But perhaps I want to start by asking you really about the Eurogroup role in regard to, and the relation between the Eurogroup and the ECOFIN. Because, of course, I mean, there's a few major developments that have happened. I mean, first of all, we've lost a big member of the EU, the United Kingdom. So the overlap between the Eurogroup and the ECOFIN is actually much more significant. And we've seen now during the COVID pandemic that the joint fiscal instrument that you're calling for, that many of us economists have been calling for, hasn't been created at the Eurogroup level. I mean, the BIC is dead. I mean, it was ended, the Eurogroup budget, and instead we've received the EU recovery, next generation EU fund, which really is an EU instrument, and the EU is scheduled to borrow up to 750 billion euros on the capital markets, and therefore create a safe EU asset, right, and not a safe Eurozone asset. So if you could just give us a sense of what is really in the current situation the added value of the Eurogroup as an institution relative to the ECOFIN.
Very well. Thank you. Thank you for your question. It is a very important one, indeed, in many dimensions. Let me concentrate in a couple of them. First of all, the Eurogroup is a coordination device, very important one, and very well understood among finance ministers that are represented both in the Eurogroup and the ECOFIN. Of course, the ECOFIN is a very important dimension in the way we manage the European Union responsibilities, but we take that as a shared responsibility with the ECOFIN. So we all know that the legislative process goes through the ECOFIN, but the flexibility and the more permanent role of the Eurogroup in terms of the ongoing coordination process across Europe is of utmost importance right now. One example, and you mentioned that was big, was the budgetary instrument for competitiveness and convergence. It was a very brave debate that we had last year in the Eurogroup in inclusive format, with the outs as well, and that led us to agree in October in a structure that is pretty much present in the RRF structure and framework as well. I think we must continue to press in the euro area to have a permanent fiscal instrument that can be used over the cycle. It's not something to take care of cyclical fluctuations. It's really a much more structural device for us to make, to allow precisely for competitiveness and convergence in the euro area. And that permanent instrument must be there at all times, and I'm sure that that will be pursued like that in the future. You know, just to conclude, the flexibility inherent to the EG gives it this group bigger advantage over the ECOFIN. We must deal with this very carefully because, of course, And we open up the Eurogroup to external contributions. Transparency issues were taken very seriously in the last 2 years and a half, and that must be the case in the future as well. But the idea of shared responsibility with the ECOFIN is very much at the core of our action.
Thank you. So, I mean, just perhaps one follow-up question on this point, because I'm sure many of us in our audience really want to understand a bit better the Eurogroup, and also you mentioned the Eurogroup in inclusive format, and I mean, just to explain to the listeners who are not from the Brussels bubble, so the Eurogroup in inclusive format is actually the Eurogroup plus the ministers of the EU that are not in the euro area. So it is de facto the same people like the ECOFIN. It's just that the president is a different one. It's the president of the Eurogroup and not the president of the council, which is rotating every 6 months. So I guess perhaps I can push you sort of on that point. I mean, can you say a few more words about what you think really is the role of the president of the Eurogroup, which is a long-term position? I mean, it's a long-term in the sense it's 2.5 years, the mandate, and then up for re-election. But it's 2.5 years, while the ECOFIN is really every 6 months, right? And so every 6 months, there's a new president in the Council of the EU, or like in all the other ministerial councils. So if you can enlarge a little bit on the role of the president and sort of also the fact that he or she is there for many years and can sort of guide a bit more the group and the informal group. And perhaps the other point I want to push you on, and if you can say a few more words on this issue of transparency, because obviously when the ECOFIN takes a decision, that decision in the ECOFIN is public. And I think if I remember correctly, one also knows the voting behavior of the individuals in the ECOFIN, I mean, of the member states in the ECOFIN. But in the Eurogroup, the discussion largely remains an off-the-record discussion, which on the one hand is a good thing because it allows for free exchange. On the other hand, it is being as lacking transparency on major decisions that are being taken for EU citizens. So perhaps you can sort of go a bit more on those 2 points, the of the president and the issue of transparency. I think many in the audience would be really delighted to hear more from you.
Very good. So it is indeed kind of an hybrid group, the Eurogroup, even in the context of European institutions. There are a few differences. Indeed, the Council presidency rotates every 6 months, and that's also part of the reason why the European Council itself was created with a permanent presidency. So we felt the need in Europe at some point to give some stability to these long-term debates, which did not preclude the existence of the rotating presidencies, but include all the work, that very important work that is done by the rotating presidency within the institutional framework of the European Union itself. But there is another big difference between the Eurogroup president and the European Council president, and that is that the Eurogroup president is a finance minister himself or herself. So he or she is a peer to colleagues. So this makes a big difference. And it's one that, in my opinion, should be preserved in the future. So what we want is a little bit this shared responsibility between coordination and the legislative process, also to make sure that we have intertemporal consistency in terms of the policies that are adopted. And in the Eurogroup, we don't vote. So we don't take decisions by voting. We always look and search for consensus. But let me go back to one of your point on the inclusive dimension of the Eurogroup. I think it was of utmost importance to have everyone on board of the debate in the Eurogroup, even in issues that were very much connected with countries sharing a common currency. It is very important for us, the euro, of course. It is highly valued by our citizens, but it is important at all moments to have all countries involved in these debates. Probably, I'm not going to take lessons from the past, especially as things are still being decided in terms of the Brexit, for example. But maybe if we have taken in the past all members outside the euro on board of very important debates we had in the euro area, maybe the outcome would have been different. Because this is again a shared responsibility, even if not a direct one, an indirect one, and maybe the UK would feel much more involved if some of the debates in the euro area would have been taken in inclusive format. We made it very, very often in the last 2 years and a half, as you know, and I am very proud of it.
On the transparency point?
On the transparency, we actually took a very important debate within our structure in terms of transparency. We now follow pretty much the rules that other council formations also follow. We invited people from outside the group of ministers and institutions. I invited all European Nobel Prize laureates to come to the group and discuss very important issues with us. Other leading economists in several areas. Unfortunately, we don't have that many European economists as Nobel Prize laureates, but we should strive for that. And we actually now publish very detailed summing up letters, the agendas, the debates. We still preserve the environment for a debate that is meant to be of coordination and not a legislative debate. It is very important to have it in a very open and frank exchange of views. But all ministers are accountable to their parliaments. I have visited the European Parliament several times in the last couple of years. I also invited for the first time the president of the Econ Committee of the European Parliament to discuss with us the economic situation and the institutional dimension of Europe. Both the present president and the previous one were with us on a biannual basis to discuss it, and this was very important in order to also open up the Eurogroup to all these other institutions.
Okay, so let's talk a little bit about the more policy questions going forward. And I think you delivered a lot of points already in your speech. But let me, I think I wanted to dwell on three really. I mean, one is the fiscal stance of the Eurozone, and I think you described quite a strong fiscal response that we've seen so far, and I'm to the COVID, and I think I was very pleased by the strong fiscal response. The worry that you expressed is premature fiscal tightening, and I think it's actually, in my view, a very good point to make, and certainly something we need to take serious. And I guess my question is, if you can enlarge a bit more on your thinking around that point, and also on what it means for the rules. I mean, there's obviously the debt rule. You mentioned the debt rule. So for those non-specialists watching here, the EU has a debt rule which requires member states to reduce their debt to GDP ratio to 60% by 1/20th of the difference between the current debt level and the 60% of GDP. So applying that rule would mean substantial fiscal tightening for a number of countries that have high debt levels. And with COVID-19, the debt levels have increased everywhere. So I mean, should your successor really initiate a strong and far-reaching debate on basically a revision of the fiscal rules, a revision of the fiscal compact, a revision of the SGP. You mentioned the potential output issue, which is another big issue, and we have lots of measurement problems there. And should there be really a complete revision? And if so, in what direction should the fiscal rules develop? Towards expenditure rules, or what is your vision?
Okay, thank you. This is a very, again, interesting question, and it's very political and sensitive.
Well, you are a politician.
No, it's true. First, we should not be overwhelmed by the idea of revision, because sometimes we start already feeling pressured and overwhelmed because of that idea, because it is underway. I mean, the Finnish presidency, for example, took a very important lead in the idea of promoting or debating a revision of the rules. I have a very critic position vis-a-vis this idea, and I mentioned in my introductory statement, of writing a complete contract type of idea behind the rules. This is totally foolish. It will bring us into more and more problems in the future, and we should not try to pursue that avenue. But having said that, rules are very important to coordinate our policies and to build trust that can be used in the process of further integration in Europe. And I think we need to use them. So that's why I also think we need to engineer a process of going back to taking us into a trajectory of fiscal responsibility and sustainability in the future. The measures we took, fiscal response you mentioned, was one that was taken within the rules and in the name of sustainability, because if we had not taken that measures, our trajectory will have been explosive in a much worse direction than it was. But there are a few lessons and one fact actually that I want still before going to the lessons to the future in terms of the revision of the rules. We were actually quite successful in implementing these rules before COVID-19. It's not only that we had the lowest dispersion of fiscal stances ever recorded among the 19 member states, but 14 out of these 19 member states were at the medium-term objective defined in the SGP for fiscal stances to be, and this medium-term objective is quite demanding. Is the fiscal position that preserves and guarantees stability over time, given the level of debt, given the amplitude of business cycles, it's a very important objective for all of the 19 countries, and actually 14 out of the 19 member states were at the MTO. This is very, very important. And so we must build on that recent past. It's not a very distant one. It's quite recent, and think of what can be used to engineer the process of going back to that. And there's one thing that we must avoid, which is using the procyclical or almost self-fulfilling dimensions of the SGP. I mentioned that in my statement this morning as well. If we run to impute to the potential output, which is an unobservable, the impact of something we are still to measure and still to evaluate, we will create a spiral, a negative spiral of fiscal consolidation, coordinated fiscal consolidation, and reduction in potential output measures that will bring us again to the same problem we were stuck a few years ago, and we need to avoid that. The RRF is a very good answer to that. So now we have the instrument, so we don't need to go and follow the same path. To conclude, the revision that is envisaged is one of simplification, not really a revolution in the rules. We don't need it. We proved actually that we were able, within the existing rules, to provide unprecedented responses in fiscal terms in our economies. So we probably should rely more on observables and less on unobservables. This is a lesson that I also share pretty much. And using structural approaches to coordination instead of mechanical, algorithmical approaches, more keen to this complete contract type of nature than in the future, but with rules and with coordination.
So we have already a lot of questions on Slido, but I can't resist asking one last, and then I really run through a few of those Slido questions.
I will make a shorter answer.
Yes, please. And the one last that I really want to ask is on the financial system. And you mentioned banking union, you mentioned capital markets union, you mentioned that currently the financial system and the banking system is actually doing okay and a source of stability, I think you said, but that we cannot exclude things going bad in the future. I mean, which is in a sense almost what you would expect if you have a very deep recession at some stage. That ends up in the balance sheets of banks as non-performing loans and so on and so forth. So if you could just give us a sense really of what's the Eurogroup view and your view on the fragility of the banking system and the setup for managing that going forward. And because, I mean, obviously banking union isn't finished. So how will we manage if things go bad? I mean, how will we deal with a systemic crisis should one arise? I mean, if you can just share a little bit your thinking on the financial system, and then perhaps really short, and then we will ask a few questions from the audience.
Okay, that's one of the worries at the beginning. I repeated several times that we should not allow this sanitary then economic crisis to morph into a financial crisis. There's no reason for that to happen. I think the common approach, the joint approach of national states plus the ECB plus the Eurogroup and the three backstops and the Commission recovery instrument can be used to avoid that. We have been following the situation in the financial system, in the banking sector in particular, very closely with the chair of the single supervision mechanism, meeting with the Eurogroup ministers to provide information on that. We all know that this crisis is an exogenous one. It doesn't come from the financial sector, on contrary to the previous one, and that the capital buffers, the non-performing loans, the interest rates, it all proves the resilience. All those dimensions prove the much stronger resilience of the financial and banking sector in this crisis than in the previous one. And I think the joint efforts of all policy dimensions, and I am very probably optimistic, let me put it like that, on saying that, but this is the view we share at the Eurogroup, that we can avoid really this to develop into a financial crisis, given the coherence of the response so far.
Thank you. So let me get to a few questions from the audience. So and I will try to group them because many are overlapping. So one person asks why the Eurogroup does it need a quasi-permanent president and not a rotating presidency structure, while another person called Catherine asks, was it challenging to be the finance minister of Portugal and chair of the Eurogroup at the same time? Should the position of the Eurogroup chair be separate? I mean, are you not enjoying being president without being minister as you are currently doing? And isn't that better? And I think a third person, I forgot who here, asks, shouldn't there be even a more permanent structure for the Eurogroup president? So with a full-time a president that stays perhaps for even longer. So if you can say a few words about this, please.
Well, there are good arguments in favor of a more permanent and a more temporary and transitory presidency. The challenges of being finance minister and president of the Eurogroup are very significant. It's a dual job holder in different parts of Europe. It's always challenging, that's for sure. But I think the pros and cons of having a more permanent structure, not having a peer finance minister presiding over the Eurogroup are definitely more negative, let me put it like that, than the current situation permits. Let me put it very, very clearly. The more than 17 hours meetings we had almost on a regular basis in the last 2 years and a half are much more productive if we are talking among peers than if we have a superstructure, I mean, presiding over the coordination device that the Eurogroup is. So I definitely believe, after being president of the Eurogroup, that the current situation with weaknesses is much better than if we try something different. The challenging situation of being president of the Eurogroup and Minister of Finance, on occasion, I have to speak about my colleague, Mario Centeno, Minister of Finance, but that's something we can deal with very, very easily if both play their roles.
Okay, perhaps two more questions quickly, if you allow me. So one is here by Mr. Anonymous on the recovery fund and the fact that BIG doesn't exist anymore. And so he or she is wondering whether there's any future at all for a euro area fiscal capacity. And a person called Pompeo asks, well, shouldn't this EU next generation package, shouldn't this become permanent, and could it become permanent? So perhaps you can say a few words about this.
Well, I would definitely have preferred BIG to remain small to start with, and then grow as an embryo of a fiscal capacity, then jump into this big machine of the recovery instrument because of the reasons we had to face to find a way to have this sort of instrument. After this crisis is over, I think we will face a much simpler debate, which is not to go back to the summer of 2019 and debate all over again the existence of a budgetary instrument, which is a permanent facility for the euro area. We just need to take it and fund it in the future. I have totally agree and understand the decision at this stage to channel all resources through the recovery fund. I think this is a very wise decision. It's what it's needed. Remember that the relative size of the BIG and the recovery fund is something that is 50 times larger, the recovery fund, than the BIG. So we really need that money. And I am also very pleased to see that the framework of the recovery fund is very similar to the one of the BIG. I think the euro area, and it is now enlarging, Croatia, Bulgaria, other countries will be in the list to enter the group. Ideally, as President Juncker once said, we will have a perfect overlapping between the euro area and the European Union, and that's the goal of all of us. So it makes no sense to question nor the existence of the euro area, nor neither the fiscal instruments needed to deal with the euro area.
So if you allow me one very last question, because I think our time is over. A person Anna called Anna asked the following question. There are three candidates for your succession. What advice do you have for them, and what qualities will be needed for the next?
Yes. Well, we have very, very good finance ministers in the Eurogroup, and Europe is very lucky to have very good finance ministers. And I say this because I know them. So the three that step forward to present their candidacies to the presidency of the Eurogroup are three examples of that quality for finance ministers. Some more tenured, others with shorter periods as finance ministers, but all very much dedicated as to stay awake for more than 17 hours in meetings through the night. So one of the things that I will say to my successor is to try to keep finance ministers awake, because we really need them to sort out difficulties in Europe, and that's a challenge, and the next president must take it very seriously. Honestly, I think it's very good to have a competitive race. This is democracy. This is reflecting the different dimensions of politics in Europe, and that's the best thing I would ever thought. The process of electing the new president should be. So I am pleased with that. Finance ministers are at the core of all policies in Europe, and we must take our place very seriously and awake.
Very good. So an important quality is actually to be able to stay awake all night. That is certainly a very good point. Mr. President Mario, it's been a pleasure to host you today. Thank you so much for your open and frank words, and I very much hope that we can stay in contact, and I look forward to our future encounters. But thank you so much for sharing your thinking about the Eurogroup at this important moment.
Thank you, Guntram, and thank you all for attending.